Hello and welcome to The Upside. I'm Nicole Correale. The holiday season is officially in full swing, and with all the joy, lights, and peppermint lattes comes a flurry of spending. While kids are busy asking for the latest toys and gadgets, investors are asking a different kind of question. Does holiday shopping actually tell us anything meaningful about where markets are headed? Our next guest says, historically, not really. So what does matter? What should we be watching? And how should investors think about positioning around the season? To walk us through the data, the nuance, and maybe just a few myths along the way, we're joined by the always fantastic Denise Chisholm, Fidelity Director of Quantitative Market Strategy. Welcome, Denise.
Welcome. Thank you very much for having me.
Of course, as always a pleasure to have you, and I'm so excited to be hosting this one with you. So Denise, let's start with the economic picture. We're hearing a lot about this K-shaped economy and this divergence where higher income households still appear willing to spend while lower income households are cutting back. How do you interpret that? And is that a sign of a real stress or simply a normalization after a few unusual years?
Yeah, so let's start with the aggregate economy, right? So if you add up all the consumption dollars in the US economy and you look at it on a year-on-year basis, we definitely have seen a slowdown, and we're not seeing strong growth at all. So we've seen a slowdown from, let's call it 3-ish% consumption growth to the mid-2 consumption growth. So that is a market slowdown, and that is below median levels historically, meaning that consumption is not strong. So there is not the dynamism in terms of the US economy that we have seen coming out of the COVID pandemic and even coming out like later in the financial crisis. That said, it's also not in contractionary shape. We, like what my kids call, we're sort of in the mid range. It's growing fine. It's not contracting, but it's certainly not robust. And you hit on the trend within that consumption, which looks fine, which is it's really a tale of two consumers. But part of that is very much renormalization. So yes, you have seen wage growth slow more rapidly for lower end or lower income consumers, but it's coming out of a very unique circumstance, which for the first time, you can calculate it a bunch of different ways, but really in much of the data that I look at, for the first time in 2022, coming out of the pandemic, you actually saw lower income wage growth be much, much faster than higher income wage growth. So some of what we are seeing now, if you just hyper-focus on the last 6 months, is just a renormalization of that. So, and don't confuse nominal and real. So nominal wage growth is slowing, but inflation is slowing along with it. So some of what people focus on in nominal doesn't necessarily translate to real GDP or real consumption growth. So to make a long story short, some of what we were seeing in the bifurcated economy is a renormalization. And even though we are seeing slow growth, it's not contractionary growth either, with a lot of potential tailwinds in the pipeline for maybe holiday season and certainly in 2026.
So you mentioned something really important there, which is wage growth normalization. So how can you walk us through how that dynamic is now normalizing? And does that make that consumer data harder to read right now?
It definitely makes it harder to read in the sense of historical parallels. So if you look back at history, you can look at the Atlanta Fed publishes a great index on quartiles of wage growth within top earners to low earners. And you can see that 2022 is the first instance where you saw a flip-flop in the data, meaning that wage growth grew much more robustly down the income spectrum. Usually you see the same gap apply, but it actually gravitates wider over time. And you saw that flip-flop in 2022. So some of this is a renormalization, which I think is unique in the sense that a lot of times when we evaluate cycles as either investors or economists or strategists, what you look at is the unemployment rate driving that differential. And this all was around full employment, meaning that we haven't really seen an escalation in mass joblessness. And that's where you usually get these strange wage growth dynamics. So in some ways, yes, it is reminiscent of other areas where you see wage growth slowdowns, especially in lower income, where you're starting to see stress. And when you look at that historically, it tends to be correlated with recessions. But this situation looks more like a renormalization, which doesn't necessarily make it any better from a stress perspective, but it does potentially make it less durable cyclical to the extent that those tailwinds that I've been talking about actually come through in 2026.
So the big question, every year investors try to use holiday sales as a read-through for the market, but as you're saying, historically, that just doesn't really hold up. So why is holiday spending not a reliable predictor of market direction, except in those extreme years like 2020 or 2008?
Yeah, so we should definitely talk about it in terms of the base case and then the extreme circumstances, because the extreme circumstances can give a good read on what's going on in the economy relative to expectations. But if you just step back and look at all the data, and I just told you that consumption has already slowed to below median growth, let's just assume that the Christmas season is good and consumption reaccelerates into that. Does that change your odds of a market advance if it accelerates, meaning that holiday spending is beneficial, or if it continues to decelerate and holiday spending was poor or below expectations? And what you find is in the fourth quarter, stocks have a 90% hit rate of going up in either case. That's kind of what people call the Santa rally, which is a little bit of a cautionary note in terms of what you think you might know in terms of the influence of holiday spending on stocks, because a lot of times there is a lot of hand wringing going into every holiday season where investors become overly concerned. And at the high level, you do see that Santa does finally come. Now, you highlighted these two examples where, or there are examples. 2020 was a great one that sort of showed you that holiday spending was much, much stronger than investors expected. And that sort of was a nod that we were coming out of the COVID pandemic from an economic perspective much faster than people thought. And 2009 was the exact opposite case. So when holiday spending was quite poor, much poorer than expectations, that was a sign that things were not nearly as rosy as investors expect. So it is true that the extremes can be telling, but I think your base case as an investor going in is that most of the time you don't have extremes. That's what makes them extremes. And most of the time it doesn't help you think about what to do in terms of your portfolio, in terms of invest or not invest in stocks.
So to your point, most fourth quarters, whether consumption is accelerating or decelerating, we still tend to see the markets maybe move higher, the Santa rally. So was that a function of sentiment, seasonality, or simply markets pricing in better than feared outcomes?
In some ways, all of the above. And every year is different, and yet every year the same seasonal trend tends to apply, with the exception of these extremes. But I do think most of it, when you sort of look at it, is the hand wringing around, will Christmas come? Is consumption softer than average? Is this going to be a problem for consumers? There's always the concern that consumers will stop spending. And I always like to say that as much as we understand that, yes, a lot is based on the US consumer because they're, more than 75% of GDP, the consumer usually does spend to the extent that they are still employed. So I kind of like to say that Goldilocks, as much as it seems like it's a wish, has the highest statistical odds, meaning that Santa does usually come, the consumer does usually spend.
If we were to see a positive surprise this season, what would drive it and what would it look like in the data?
I think in the data it would look like a reacceleration in consumption. And it might be that we find out that the consumer had much more in savings than we thought. So always remember when you're looking at government statistics, and this even goes in terms of retail sales, but consumption growth, is that it's heavily revised. And when we think about income, it's hard to count income if they're the US government. So we usually find there was more income than we thought, which is why the savings rate is one of the most heavily revised data series that we have. We end up having more income. We thought we had less income. Therefore, we had more savings, and therefore consumption was much stronger than we expect. So I do think that there is still some positive surprise potential in terms of the fact that we still have full employment in the US, meaning a very low unemployment rate. There is very slow growth, but job growth nonetheless. Income usually gets counted after the fact, and we may, by the way, have more savings than you suspect, all which might mean that despite the hand-wringing and the surveys that we've seen that the high-income consumers are going to spend and the low-income consumers are not going to spend, it might in aggregate look a whole lot better than people think.
So I may just get a nice, lovely gift under the tree this year is basically what you're telling me. I shouldn't be too worried.
You might, maybe I'll send it to you.
Oh, Denise. So we've spoken many times before, and you always point to credit spreads as the real barometer of consumer stress, especially at the lower end. What are high yield credit spreads telling you right now? And are we seeing stress that looks systemic or more isolated?
Now much more isolated. So we're not seeing any systemic movement in credit spreads, even with the government shutdown that we've seen, even with the stress on sort of that area of either the economy or that part of the consumer. You're not seeing any massive move higher in high yield credit spreads, which is the credit market saying, again, it's not to say that there are no points of stress in the US economy. There always will be. It's very rare that you're firing on all cylinders. And honestly, if you're firing on all cylinders, usually the risk reward shifts a little bit negative. It's a little bit of that grind it out that tends to be the most beneficial environment for stocks. And that's sort of the situation we're in. So when you look at the credit market is pricing off aggregate credit, which is not to say that there's no pockets of credit that aren't seeing rising delinquencies or rising insolvencies. But the credit market overall gets concerned when there's a tipping point where those become correlated to other asset classes. We're not seeing any of that right now. The stress that we see in maybe subprime autos and in some parts of housing, that's not being systematic, pervasive stress in the overall credit markets. And when the credit market doesn't see broad-based insolvencies, and the equity market is afraid of whether or not Santa is going to come and whether or not there's a weaker consumer, that tends to be the situation statistically that the stock market can end up climbing that wall of worry. So sort of the situation we just talked about where there's a lot of concern going into Christmas, and more often than not, the market ends up climbing the wall of worry because it wasn't necessarily as bad as maybe many investors expected.
And speaking of this wall of worry, I guess, I don't know, maybe we could partly blame it on the headlines. Like this time of year, the headlines tend to focus on sales numbers, flashy consumption stats. But what's the biggest thing investors may be paying attention to then that they shouldn't? And what's the better metric or signal to focus on instead?
Yeah, so when you think of, Santa and the rally, we just talked about the fact that overall Christmas spending might not be predictive for any parts of the, either the US economy or the overall stock market. But I do think when you think about consumer discretionary stocks, it's not just revenues. It's not just sales. The two more important things, and this creates the complication in terms of what the market is discounting, is one, margin. How much money are they making on those sales? Because if they had to price it down to move it, you might get revenues that look better than average, but you might get profits that look less than average. But the other complicating factor is who doesn't know that some of the areas of weakness, like restaurants and some leisure areas, are already weak. So many of that might already be priced in. When I say priced in, it means the stocks are cheaper relative to the rest of the market, relative to the historic average. That's why you can end up in this situation where you might get the numbers right, but you actually might get the stocks wrong because it's already priced in bad news. So when you think about how to think about Christmas spending, remember, it's not just revenues driving the idiosyncratic moves within the consumer discretionary sector. It's profitability and it's the starting point on valuation, which makes it a little bit complicated to directly translate it.
So from that, what's on your market wish list this year? Which data trend or economic signal would you like to unwrap under the tree?
Yes, it would have to be high yield credit spreads. I would like to actually see them break down to new lows. So from my vantage point, remember, if you're me, you're just looking at data and you're saying, what are the beneficial signs for overall equities? What I find is that improving trends, but not very exceptional trends, are the sweet spot. So good news is actually makes me wary. So above 25% earnings growth, below 80 basis points credit spreads, all of these good things that most investors would say, well, this is good news. We're firing on all cylinders. When you look back historically, that's actually a negative risk reward. So what I want to see is credit spreads have been a little bit elevated, but not anything meaningful over the past 6 months. I would like to see the credit market say, and it looks like it is still improving. So that's what I want to see under the trade.
And what does your perfect holiday day look like for you?
Oh, well, it would have to be just spending it with my my family. So my two girls, I have a college student, so having her come home, spend it with her, and I have the last year at home with my senior daughter. And I will have to say, I know you also have a pet, Nicole. I will have to say that this is Penny's first Christmas, my Labrador Retriever, and I'm kind of just hoping she doesn't take down the tree.
That's so sweet. Happy first Christmas to Penny. Thank you, Denise, so much. And you heard it here first. The headline, holiday spending numbers may be noisy, but the underlying credit signals, margin dynamics, and valuation starting points are what really matter for markets heading into year end. Thank you, Denise, so much for being here. Always insightful. Always great to speak with you.
Always
and
great
thank
to be
you.
here.
Thank you. And thank you for joining me on The Upside. For more investor content, be sure to subscribe to our YouTube page to never miss an episode and sign up for a newsletter. And remember, working with a financial advisor is the best investment you can make on your financial journey. Thank you again for tuning in. For The Upside, I'm Nicole Coriale.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.